Hi, Winning Investor Nation. Welcome to Monday Market Insights. Good morning, Ian. How are you today?
I'm doing well. How you doing, Amber?
I'm hanging in there, Ian. Lots of
Hanging in
stuff
there.
going on. Yes, lots of
We're
stuff.
all just hanging in there right now.
We're hanging in there at the mercy of the Fed.
Mhm.
Okay, so just as an opener, Ian, and everyone watching, the FOMC delivered, as expected, a 75 basis point rate hike on September 21st. And what was most notable, nearly 2/3 of the Fed committee members actually see rates ending this year at a median of 4.4%, which is higher than the 4.2% anticipated by the markets. So we're looking at a possible 75 basis point rate hike in November, followed by a possible 50 basis point hike in December. Fed Chairman Powell appears to be unwavering in his mission to restrict U.S. economic growth in order to combat high inflation by using the only tool that he has, right, Ian, which is raising rates. So now the silver lining in this situation is that the Fed is front loading higher rates now to possibly get its rate hikes done more sooner than later. That's a possible silver lining. And they have an opportunity to aggressively ratchet rates higher. So they're going to actually just seize that opportunity with both hands. In all, the Fed's current actions and projections were more hawkish than most expected. But from the Fed's point of view, they will not let up until they see a slowdown in the US economy. Now, Ian and I believe we're already in a mild recession. One thing is for certain, Winning Investor Nation, markets look forward. And we're already seeing falling prices, slowdowns in different sectors like the housing market, as well as commodities. Now, I want to share this chart, Ian. It's a Bloomberg table that actually shows prices for 21 commodities. A quarter to date, 76% of these commodities are showing price declines from steel rebar to soybeans. So the Fed may be hiking rates using backward-looking data that's been discussed. Some feel that the US economy's core inflation actually peaked with COVID. And I want to just end with this tweet. And this tweet exchange, which included Elon Musk and Cathie Wood, and a Twitter person, Ron Madison, actually showed that instead of inflation, we need to be focused on coming deflation. Now, the quote is, we need to be pounding the table that this is equal to 1949, when inflation was breaking at 10% and quickly retracing to negative 2.5% deflation inside 12 months. Whether the Fed waits a month or pivots, it won't matter. Deflation hits them in the chin because they use old data, end quote. So it's important to note here that our stock recommendations are deflationary in nature because they are innovative. They're innovative companies that actually help businesses of today do more with less, as Ian always says. So if deflation does rear up, it bodes well for our particular 2.0 innovation stocks as their tech is implemented by future forward-thinking companies. These 2.0 stocks will see sales revenues increase, which in turn attracts stock investors seeking a growth in their growth opportunities in their investment portfolios. So that was my takeaway from the Fed rate hike. So what do you think, Ian? What are your thoughts?
That's a lot to unpack, Amber. Thank you for that very comprehensive look at what the FOMC did last week. You know, I was reading one of my old colleagues, this guy named Peter Bookvar, wrote about the Fed rate hikes, and he described it. And you know, look, some of your viewers might be familiar with this, maybe you're not, but he described it like when you eat a THC gummy. And the idea is that, you know, sometimes you'll eat a THC gummy that's 5 milligrams and, you know, you don't feel any impact of it. So you say, oh, okay, I'll have more. And then you don't feel it, and then you hit a third, or perhaps, you know, maybe you're drinking at a bar, and you know the first shot does not impact you, and so you start drinking more, and before you know it, you've done 5 or 6 shots without moving, and then when you go to stand up, you fall over.
Oh my God.
That's the problem with the Fed's tendency to overshoot, is that once they hike rates, and the way they're doing it now so aggressively, they're not pausing to see what the impact is.
Right.
And, you know, the worry obviously is that they can overshoot and lead to this deflationary environment, which is going to be good for growth stocks. But if we go into a deflationary environment, you know, we're going to have to go back into QE again. Now, obviously, the markets have been volatile and erratic over the last week. I think the NASDAQ is down about 8% from where it peaked just during the FOMC meeting or right after the announcement. The one thing I'll say is that whenever the markets are extremely volatile like this, and we're getting to an oversold position, is that you're going to start to see these very dire macro predictions, like the US is heading into a depression, and, you know, you're not going to have any growth in stocks over the next decade. And from my experience is that those people making the dire predictions when everything is just going wrong are usually wrong themselves. You know, the time, if you wanted to short stocks, the time to do it was earlier this summer. Do not sell down here. If you want to sell something, don't sell down here in the hole, because in these bear markets, even if this is not the end of the bear market, you will see a rip roaring, you know, rip your face off short squeeze rally that can add 10 or 15% to the S&P 500 or the NASDAQ in just a couple weeks if we have any good news. Now, what the market is digesting right now is Jerome Powell is having his quote unquote Volcker moment. And they call it a Volcker moment because Paul Volcker was the head of the Fed who took over in the late 70s. But in the early 80s, you had rampant inflation that had been bad for about a decade. And he said, you know, inflation's at 10%. I'm going to increase Fed funds to 12%. And he did it. And inflation started going down. The economy went into recession, inflation went down. But what Volcker did was it actually paved the way for 2 decades of low inflation and great growth. You know, and if you were an investor back in the early 80s and were buying during Volcker's recession, some of those investments back in the 80s, especially in technology, were absolutely incredible. You're talking about buying early stage of Apple, early stage of Intel, Microsoft, some of these companies that came out of that recession and led the way into the 90s. Then eventually, you know, the growth ended at the dot-com bubble, then picked up again in 2003, 2004. But so what Powell is doing is telling the market and telling investors that he's very serious about inflation. And there was just one thing that really resonated with me. I'm going to leave it with this. I watched the Q&A, and as Powell was walking off stage, you know, they asked him, hey, you know, your target for inflation is 2%. Like, are you really going to be able to get inflation, which is now 8% down to 2%? And he basically said, just watch us, you know? And I think that when he said that, the markets, people said, all right, you know, this guy's serious. But the longer term picture is that the Fed, because they're doing this, is going to maintain their credibility. And it's their credibility that matters more than anything over the long term, because you don't want to have a scenario where you just don't have a central bank that can function anymore, because you know their ability to kind of transform the economy and allow for economic growth. You know, there's a lot of criticism of the Fed, but before the Fed came in power in 1913, you know, you would have a banking crisis every 10 years, every time you had a recession. You don't have that anymore. You have a banking crisis every 100 years or so. So case in point, I just think that like people are making huge downside macro calls. Everyone is worried about the world ending. Whenever you see that, it usually is getting closer to a bottom than not.
Okay. I agree.
All right. Oh, one other thing too, I want to talk about with the commodities index. That's great news that commodity prices are coming down because all these input costs are going down. The one problem we still have in the economy is that wage inflation is still high. So, you know, and then you're starting to see a lot of national brands that are hiking their minimum wage. I think the one thing, and Bill Ackman said this morning, that the US could really benefit from is an immigration policy that works for our economy. Bringing in more workers, increasing the supply of workers so that restaurants, you know, can be fully staffed, and around, and a lot of businesses and manufacturing. Obviously, we're going to have more manufacturing in the US. We're going to need more immigrants. So we're going to need Congress to get together and create a functioning immigration policy, because we have too many people in our workforce that aren't participating for one reason or another. You know, they might be retired now, they're not working anymore, or they might be in between 2 jobs. And so I think that immigration can go a long way in terms of solving that macro problem where wages are growing too fast. And that is the major concern of inflation right now. It's more a labor issue than it is a commodity issue.
Right. That's an excellent point, Ian. Excellent. Okay, so we have a few economic indicators that are releasing this week. There's 8 major ones, so we can cover those so everyone can be on the same page. 8 major US.
Oh boy, okay.
So
we thought that was going to be a slow week ahead.
No, it's not a slow week. So most of the forecasts for these indicators are showing a softening with a few exceptions. On Tuesday, August durable good orders is forecast to post an unchanged rate of negative 0.1%. September's consumer confidence is actually projected to show a slight increase while August new home sales may show a softening.
Yeah, we want to see consumer confidence weak.
Yeah,
we want you want good news in the stock market. You got to see bad news for the economy.
Exactly. So that's a misnomer there.
So if you get a call about how you're feeling about the economy and you're part of the consumer confidence survey, say something very negative.
Oh no. People, you will.
I'm biasing the sample, Amber.
I know, I see that. You never know. On Thursday, we have GDP annualized quarter over quarter. The second quarter, third reading will post at 8:30 a.m. Eastern time with a projected negative 0.6% print. And on Friday, we have August's personal income and spending, which may show a slight uptick. September's M&I Chicago PMI is projected to decline, while September's University of Michigan sentiment is forecast to remain unchanged at 59.5. These actual Friday releases will post between 8:30 a.m. and 10 a.m. So that's the calendar for the week. We'll see. And 2 consumer sentiment surveys. So we'll see how they post, what the end result.
Yeah, I think they're going to be lower than expected. I mean, that's my guess. I think people are already seeing mortgage rates above 6%. If you look at like all these online retailers, they're already discounting everything. So obviously they're not seeing strong demand. No. So I think those are going to start to slow down. And also the stock market has been down the last couple of months, which is usually the signal that people base how they feel about the economy off of.
Good point. I'm glad you brought up the mortgage rate data, Ian, because I have a chart I like to share with everyone. Mortgage rates, as we all know, have been increasing. And even with a 20% down payment, this Bloomberg chart shows that interest payments alone have nearly tripled since their most recent low of $577 to over $1,600 added to the principal of a mortgage. So that's
it's insane. If you bought, let's say, a $500,000 home at the beginning of this year with a 2.75% 3% mortgage at the same current mortgage rate of 6.25%, your $500,000 home, the payment would be the same as a $350,000 home. So you're talking about a 30% discount basically in real estate. And obviously, it's not a linear trajectory, which means that like the number doesn't change on 500,000, million. The percent actually declines more, but it just shows you that, affordability is way up. I was looking at a chart of income to housing costs, and it is just as stretched as it was in 2007. Basically, either housing prices have to come down or incomes have to go way up.
Yep, that's it. I mean, you can't have it both ways. You can't do this.
Right.
So see how it works out. Okay, Ian, so turning to the crypto market, we had the question posted to our YouTube channel comment section for last Monday's video, and it's from Philip T. And Philip T writes, thanks for the updates. With Ethereum moving to sharding moving forward, would Matic likely lose out? That's one of the questions for you this week, Ian.
I love this question, Philip. Thank you for asking about sharding. Our readers are very technical, Amber.
Oh, yes.
Our viewers, sorry. So for folks of you out there don't understand, let me just explain exactly what sharding is and how this would fit in with other layer 2s. So Ethereum obviously is the world's second largest blockchain. It's the currency the currency is called ETH, Bitcoin being number 1. And it's going through a major upgrade. We've talked about the merge, which took the consensus mechanism, which is the way it validates and secures transactions. And that went from proof of work to proof of stake. And that happened guess 2 weeks ago now.
Mhm.
And there's more upgrades that are coming. What the merge did was not increase transaction speed. That is going to be in a further upgrade. And what's the upgrade? It's called sharding. And essentially what it is it breaks the blockchains into final pieces so it can be lighter and faster. And so think about how this works. If you are a decentralized node and either you're staking or you're running a computer in a proof of work system, what you're doing essentially is keeping track of who owns what. And in order for you to keep track of who owns what in all these transactions, you have to have the entire history of the blockchain, right? So when you're running a Bitcoin node, you're validating these transactions, you're validating the current transactions against the entire history of the blockchain. And so this gets heavier as time increases, right? There's just more data to process to understand who owns what, because you have to have the entire transaction history. What sharding does is it says, okay, after a certain point, the Ethereum blockchain is a finality. And so anything from that date forward starts a brand new blockchain. Is sharding. So if you're a client, which means that you're a node and you're validating these transactions, you don't have to look at the entire history of Ethereum blockchain dating back to 2015. You just have to look at something that is more current. So it makes the Ethereum blockchain much lighter and will allow to process transactions faster. Now, okay, so when we have sharding, transactions per second is expected to go up to 100,000, maybe even more, right? And so this is 4 times faster than what Visa and Amex do. So Philip's question is basically, why are we going to need all these side chains if Ethereum is fast enough to handle everything? Well, the assumption that Ethereum is going to be fast enough to handle everything that it could possibly do in the future at 100,000 transactions per second, I believe, is flawed. Because you're not just talking about reinventing the payment system or the financial system. You're talking about a decentralized cloud network, decentralized network bandwidth, all types of digital resources that can be better provisioned using decentralized networks will be provisioned that way, because it's going to allow people who have those type of resources to unlock them. The other thing is, if we rebuild the internet in a Web3 model, it's much more than the financial system, because now you're talking about every little piece of media that's out there, whether it be a digital video, a movie, a picture that you might have taken, turning into some type of NFT. The value has to be tracked somehow and transacted and moved, and it's going to take a lot more than 100,000 transactions per second. So here's where some of these layer 2 fits. Polygon especially is creating a niche for itself in the gaming. Amber, you've talked about this before. The gaming market is $200 billion annual market. I mean, this is massive and could even be getting bigger, right? So Polygon has hired the head of gaming at YouTube. They have a guy who came over from Electronic Arts, and they're trying to carve out this little niche in blockchain games. And then you're going to see other layer 2s work on other little niches. One, could be focused on music. Another one could be focused on video. But what is important about the Ethereum chain and how this fits in is that all these transactions that are happening in layer 2s like Polygon eventually find their way to the Ethereum blockchain, right? So they're using Ethereum as sort of the base layer, and then they're creating the side chain where they can do faster transactions. But they're using Ethereum for its security and basically, its history and the fact that the chain doesn't go down. And so that's why Ethereum will still be important, even though you have all these layer 2s. And I think that this ecosystem is going to continue to grow, and layer 2s will be essential to the growth of Ethereum, because you can do things on Polygon that you can't do on Ethereum just right now. The transaction speed is so much faster, so you can run these games. And so, Philip, thank you for the question. Sorry, it was a little long-winded, but I wanted to make sure that people who didn't really understand sharding, as you probably do, understood what question you're asking and why I think that Polygon and other layer 2s are going to be essential to the growth of this ecosystem.
That's an awesome response. Thank you, Ian, for taking time to reply to Philip. And thank you, Philip, for your question.
Yeah, great question, Phil. We'd love to
Awesome
hear that.
Of course. And if you're watching and if you have a question that you like for us to answer, Ian to answer, especially on crypto market or anything you like, please post
Anything.
them.
Let's talk macro. Give us some macro questions.
Yeah, that's what I was thinking.
Yeah.
Here's some macro questions. We love to get them. You can post them in the YouTube comment section of our video or email them to winninginvestordaily@banyanhill.com. So, Ian, on the Megatrend news front, you ready to hear some interesting Megatrend news? I'm
Let's
always
do it. I love mega trends.
yeah, they're out there. So lithium refining is hot, HOT,
Mhm.
and it's actually its need is off the
And
charts.
HOT is not the ticker symbol for the lithium ETF. Amber was just spelling hot.
Just
Okay.
hot. Yes. So its need is off the charts for electric vehicles as EV revolution really powers ahead. So first I want to just go back a little bit. In my July Megatrend Thursday video, which I aim to do every Thursday, maybe most weeks of the month, which focuses on what's happening in technology, etc. A video I did back in July titled "One Key Megatrend to Watch." I shared how lithium refining was a megatrend to watch, and I highlighted 3 companies that stood to possibly gain in this growing market. Lithium Americas Corp, Albemarle Corp, and Livent. Well, since that video aired, their share price are up around 20%, 22%, and 38% respectively. And at the recent peak on September 14th, Lithium America was up as much as 53%. Well, there's likely more room to grow as Tesla's potential lithium refinery in Texas is now set for a public meeting next week. According to Teslarati, Tesla is considering the Gulf Coast of Texas as a potential location for a battery-grade lithium hydroxide refining facility. Isn't that interesting?
Yeah, that is interesting.
So
It's like replacing, where the other energy is.
yeah, that's what it's exactly. So Tesla has actually filed an application with the Texas Comptroller's Office, and Tesla noted that the facility would be the first of its kind in North America. In the application, the EV maker suggested that the lithium refinery could be located anywhere with access to the Gulf Coast shipping channel, end quote. Actually, there's more to this. They said, quote, thanks to this, the facility's output can be packaged and shipped by truck and rail to various Tesla battery manufacturing sites, supporting the necessary supply chain for large scale and electric vehicle batteries, end quote. So Ian, lithium is a continued megatrend to watch. And I have to say, Ian himself is all in on lithium with an open position in his portfolio that has an open gain of 86% right now. So as shameless plug, if you'd like to learn more about Ian's investment recommendations and how you can get started following his research that really focuses on tomorrow's biggest tech trends today, well, please click the bull icon right here over my shoulder to get all those details and to get started. So I just thought that was something to highlight for this week.
It is. And like people think about lithium and they think about EVs, and I think that there's something in the media that kind of says like, oh, EVs an $80,000 car, but it's not. Like, GM has a $30,000 EV on the market. Hyundai, their Ioniq is below 30,000. Tesla's working to a $25,000 car. And it's not just in the US. I mean, in China, 20% of new car sales are electric vehicles. And, if you look at Geely and Boyd and NIO, they've got EVs that are under 15 grand. And, they have these small cars that kind of get around the cities. And, I just think that lithium trend, obviously we're going to have some hiccups between here and where we are in 2030, but that's just a market that's just poised for so much growth. And it's also, in battery cells as well for the renewable energy world. I mean, lithium has many use cases. It's sort of like the wonder commodity right now, right? Because it's in so much demand.
Yeah, lithium, it is a wonder commodity indeed. And I'm seeing more Ioniqs on the road, actually, the Hyundais in my area. They're almost competing with Teslas in some respects. I'm like,
it's a good looking car. It's a good looking car. Yeah.
At Costco too. I'm like, that's
and CarPlay works in it, right, Amber? As long as Apple CarPlay works.
As long as Apple CarPlay works in any vehicle, I'm a happy camper with that.
Me too.
So that's it for this week. Ian, you have anything else you'd like to add before we sign off?
Oh, we covered a lot today. I just want to say thanks again to Philip for that great question on sharding.
Oh, yeah.
It's not often that I get to talk about sharding of blockchains on these YouTube webinars. So thanks for writing in. Yeah, and I would just say that, you know, as we're recording this, obviously it looks like the world is burning with interest rates going up all around the world, and bond markets look like they're blowing up. But, you know, when you see these really dire predictions right now, which are coming out all over the place, to me, it has been a sign that we are closer to a bottom than not. So just keep that in mind. How many times that people have predicted the end of the world, you know, over the last 3-4 decades have been wrong.
That's a good point. We have to keep it in perspective.
Mm-hmm.
Okay, well, thank you everyone for watching, and know that you can follow Ian and me on Twitter. Ian is at Invest with Ian, and I am at A Lancaster Guru. And of course, please remember to give us a thumbs up if you do find this video's content helpful, and subscribe to our channel, as well as click that bell to be notified when new videos are posted. So that's it for this week. For me, thank you so much, everyone, for tuning in. We appreciate you so much, and we wish you a great week ahead. Ian, I'll leave it to you to say goodbye.
Take care, everyone. See you soon. Thank you.